Hi, I'm Eric.
And I'm Dick. We're the Annuity Guys.
And today we're looking at how high a surrender charge can go.
Well, Eric, it used to be anyway that surrender charges were quite a bit higher. We're talking a lot of times maybe up in that 20% range. But in the last maybe 10 years or so, the states have kind of got together. The insurance companies have worked with the states, and now the rules kind of hold them somewhere in that 10% range
To start with.
To start with, yeah. I mean, it can be a little lower, it can be slightly higher, but kind of that norm would be around 10%. And I guess the question that folks have to ask themselves is 10% high? And then is relative to what?
Right. Yeah.
Because the insurance companies, the important thing that folks need to realize and know is that these surrender charges in many ways are there to protect you, to protect your money, because you don't really want the insurance company to, so to speak, have a run on the insurance company where everyone wants to just pull their money out, for whatever reason. And then it leaves the folks that want their money to be secure at risk.
Right. It's really part of the structure of the insurance company where they have to have reserve requirements that basically for every dollar they have to pay out, they're supposed to have a dollar on reserve. So in order to do that, they have to take safe, secure investments that are typically more long-term bonds and treasuries and things that are considered investment grade. And so in order for them to go out and buy those things, well, they can't be buying them and then selling them the next day because it's not as easy to turn some of those pieces over.
Absolutely.
So in order to have their obligation to fulfill the annuity that you're purchasing, they have to be able to regulate that flow very, very, very carefully.
They do, and again, this is all done actuarially, and it's all done through the state regulatory commissions that approve these surrender charges. And I when I think of this, Eric, I think of folks that I've worked with that have went through stock market corrections.
Oh, sure.
And if they didn't plan well, they put their money into stocks or stocks and bonds, and that money typically is supposed to be money that's in there for the long term.
Sure.
And if those folks had to pull it out early and they were caught in a serious correction or big market downturn, I've seen folks that have lost 20, 30, 40% pulling their money out because they didn't plan well.
Right. If you're pulling anything out at the wrong time, you're going to take a hit. I mean, you can't time the market. Well, and then guess what? With annuities, the timing aspect is all factored into when you're making the purchase. It's all stated contractually what your surrender charges are from day one. So in many ways, you know exactly what you'll lose if you had to go in and get something early. And obviously, you don't plan for that to happen because if you were going to plan for it, you wouldn't do it in the first place.
So you don't have with an annuity that unlimited downside risk.
Right.
There's also some things that many folks don't really understand about annuities. And even I've had clients, in fact, I just had one yesterday, they were asking me, well, how long do we have to wait to get our money out of the annuity? And these are folks that I had went over this question with in the past, and they had simply forgotten that they have 10% withdrawal penalties. Penalty-free withdrawals.
Yeah.
And that they had access to about $20,000 that they could pull out, penalty-free. And if you do that real close to your anniversary on your contract, you turn right around, 2 weeks later and take another 20 out. So pull 40,000 out penalty-free. And so that's something to keep in mind, that the annuities actually make some liquidity allowances to get money out because they understand that this is retirement.
Right. And now, we always say they're not the most liquid aspects, but you have to realize, you're looking at surrender periods of 5 to 10 to 15 years. Well, most of them around 10. Well, guess what? If you need that 10%, and some of them have an accumulative feature where, if you don't take 10% one year, you can take 20% the next year.
Right.
So they have built in some of these aspects. But, they're not considered to be highly liquid, but they also can be annuitized. You can get the income other ways.
Yes.
So it's really how it's been structured initially, and hopefully it's part of an overall plan and not just something on a whim you went out and said, I need to buy an annuity today.
Well, and I do feel that when folks do proper planning with annuities. When they look at their overall portfolio, they balance it. They have their emergency cash
Right.
fund, their discretionary money.
Yeah.
They have their money that's potentially invested more for growth, that's accessible, and they have their annuity money, and just these different
buckets. Yeah.
different buckets, exactly. That the chances of them having to have a surrender penalty are very, very minimal.
So yeah, so you're looking at early on 10%, but we always should say with the insurance company, if you've received a bonus, the insurance company's going to want their bonus money back.
That's true.
So
That's true.
sometimes you'll see surrender penalties in excess of 10%. If you got a 10% bonus, the surrender penalty might be 20% right off the bat because they want their bonus money back if you're going to walk away.
Well, and Eric, one of the things that I see quite frequently is that folks that have been looking at annuities for a while and understand how annuities work and the benefits that the annuity, the right annuity is going to last them throughout their entire retirement for 20 or 30 years, they aren't concerned, I would say, almost at all about the surrender charge. It's almost a non-issue.
Yeah.
However, folks coming into annuities that are just learning about annuities, that don't understand it, that's one of their greatest fears.
Yeah.
I'm going to lose control of my money.
Yeah.
I mean, I have to give it to an insurance company, and I don't have control. But you really do have what we call majority control. You control about 90% of your money.
From day one.
In the worst case scenario. It's a sliding scale that, some folks don't understand that it's a sliding scale every year, maybe every 2 or 3 years. It'll drop.
Typically decrease.
Right,
yes.
decrease. So Eric, the big question here, are surrender charges too high, and should it be a deal breaker for folks?
I would say, are they too high? No, I would say they're fair.
Yeah.
Are they a deal breaker? No.
No, not if you do your proper planning.